and welcome to this update by Tatton Investment Management. My name is Olivia Geldenhuys, and I am the head of the investment specialist team here at Tatton. And today I'd love to take you through our presentation, providing an update as to what's happening in the market, as well as showing you some of the investment opportunities that we're specifically looking at. So to take you through this process, the agenda that I'm going to be following is the following. We'll firstly look at setting the scene, and that involves looking at the high-level macroeconomic backdrop and what are some of the drivers of markets at the moment. Next, we'll look at the investment opportunities and where do we see opportunities to make money within your portfolios, but also looking at some of the risks that we're trying to mitigate against. We'll then spend some time looking at what it means to actually spend time in the markets. And this might be something you've heard from your advisor before, where it's not about timing the markets, but it's about spending time in the markets. And what I'd like to do is give you some evidence points as to why that is the best approach for your investment portfolio. And then lastly, we'll just cover off what are the key takeaways from today's presentation. So let's get started with setting the scene. Now, we always like to start our presentations with a word cloud because we think this is a very easy way to see what are some of the drivers that have actually been experienced over this year. Now, it won't surprise you to see a couple of words in this word cloud. Very large words indicate that they've been mentioned a lot in the trade publications. So things like rate cuts, which I'll talk about, things like AI. Obviously, inflation is still very much a topic that we're discussing from an investment perspective, but also in the day-to-day lives of everybody who we run money for. Now, if we have a look at each of these different themes that we've typically seen out of the quarter, we can see how this has played out over the course of this year. And it really has been a very bumpy ride. We can look back all the way to quarter one, where we saw the build-up towards Liberation Day, which was ultimately on the 2nd of April. There were also some fears at this point around inflation and whether or not the economies would continue to grow at the pace that we have seen in the past. We then moved through into quarter two of 2025, and this was where we saw the rebound really from the tariff fears, from Liberation Day, and markets experienced a very dramatic recovery from some of the falls that we saw earlier in this year. We also started to see an increased level of spending when it comes to AI. Roll over into quarter three of this year, and this is when we really started to see a bit more resilience in markets. And what we mean by that is from an economic and a corporate perspective, we actually saw that profits were relatively decent for companies operating in this backdrop. It was also in quarter three where we began to see interest rate cuts from the various central banks around the world. Now we're moving firmly into the final quarter of this year, that final stretch. We have the UK budget to look forward to, and then we also have the potential for what is typically called the year-end rally or the Santa rally. Now, if we look back at what some of the forces have actually been over this year, what are the drivers that we really want to focus on? And at Tatton, we really like to have a framework for thinking in looking at all of the information that might be presented to you within the news, from your advisor, maybe even from some of your friends. And we like to break this down into 4 key areas. And the first one is monetary policy and rates. And this is really around central banks and where they're positioning interest rates. Now, the reason this has been so topical, certainly over this year, is because of the second pillar, which is around inflation. And inflation relates to just general CPI, that consumer price inflation, or it relates to wages, commodities, and what are some of the real-world impacts of prices going higher. Now, central banks actually have a dual mandate where they need to make sure that inflation is at a level which they're comfortable with, and it's enough to actually promote growth, but not be too high that it actually deters from growth. And so our third pillar is really looking at what is the overall growth and economic activity of various countries. And there are a couple of data points that we can look at there. And one of them is that I'll cover is around Purchasing Manufacturers Index, which is your PMIs. And then lastly, something which is always going to be topical is around global risks and geopolitics. And these are the things that are grabbing the headlines, potentially providing a bit of noise and maybe even some volatility in investment markets. And it's at this point where we really want to look at what are the different risks that are present and how might we try and mitigate against that. So let's look at this in a little bit more detail. The first one I'm going to focus on is around monetary policy. Now, for some of you, you might know that we have obviously had very high interest rates over the last couple of years, and that has really been around restricting the access to capital and the access to money in the system with the view of bringing inflation down. And now that we're starting to reach levels where inflation is maybe closer to the targets that we're anticipating from central banks, we are starting to see rate cuts come through. And we have had a fair few come through from the Bank of England, but the expectation is that that will start to get to a certain level, and then we may see that stabilize over a slightly longer term period. What you can see from my chart on the right-hand side is the expectations for different regions and where those interest rates might lie as we go 1 year, 2 year, and even 3 years out from our current starting point. Unfortunately, I don't think we're going to get to the level of low rates that we necessarily saw coming out of the global financial crisis, so from 2008 up until 2021. But we are going to reach a more moderate level of interest rates. And that, again, is going to be in an environment which can continue to support markets, but making sure inflation stays at the level that we're expecting. If we then have a look at inflation and how that has changed over the last 2 years, it really has been an extreme movement. Obviously, coming out of COVID, we had very, very high levels of inflation. That's when we started to see central banks really raise their interest rates, and we got to those high rate levels, and now we can start coming down as inflation slowly but surely reaches that target. Something you might have heard often in the trade press is that getting from a 6% inflation level to a 3% inflation level can be the easy part, and it's more that sticky inflation going from 3% to 2%, which can be a little bit more difficult. And that's the position we currently find ourselves in, certainly if we're looking at the UK and what some of those latest inflation numbers are. But broadly across the globe, we are starting to get closer to those lower levels of inflation, like I said, which are still promotive of growth, but not so restrictive that we enter a recessionary type territory. We move on to that third pillar, which is really around growth and what those shifting expectations actually look like. Now, surprisingly, 2025 has actually had a significant amount of growth. And the way that we measure this is through GDP growth. And you can see I've plotted all of the different regions on the chart on the left-hand side, areas like Japan, Eurozone, UK, US, and even China. And China has been a surprising segment of the market at the moment because it is still delivering really decent growth, but we're now also starting to see their stock markets contribute to that as well. Looking forward into 2026, though, we do see that there might be a slightly lower level of growth coming from each of those different regions. But one of the ways that we can actually look to measure this is what I mentioned earlier, the Purchasing Managers Index, your PMIs. And that's the chart on the right-hand side. And what you can see is when the line for each of those different regions is above the 50 mark, that typically indicates that the economy is in an expansionary phase. When that line dips below 50, that typically means the economy is in a contractionary phase. And we can see that although we're not very high above that 50 line, we are still in that positive territory where we are expecting a bit more growth. And there is a slight pullback in some of the regions where it is maybe getting a little bit closer to 50. But again, this is for us just a high-level macroeconomic backdrop that we need to consider. This doesn't always necessarily translate into the investment aspect. Something else that I thought would be quite useful for us to have a look at today is around sentiments. Now, what's really interesting for me on sentiment is it can be a little bit all over the place. And that makes sense because there are different risks and opportunities that present themselves as we move through any given year. But what I'd like you to pay attention to over here on this chart is the solid line, which runs at about that 10 level that we see. And this is the difference between a bullish sentiment, so an aggressive thinking market's going to go up sentiment, versus a bearish sentiment thinking markets are going to go down. And the average sentiment, which is that solid line, is actually above the zero line. And that tells us that on average, markets actually have a positive sentiment and they're designed to continue going up. But what we have experienced over 2025 is we have experienced that sentiment dip really quite low. That was specifically around Liberation Day earlier in this year. But since then, we've actually seen sentiment continue to improve, and we have seen that upward trajectory getting closer to actually breaking that zero line. Now, this unfortunately has caused quite a bit of volatility when it comes to markets. But what we are starting to see is we're starting to see some of that volatility actually creep down. And you can see what I've plotted on the chart on this screen is looking at the volatility of both the equity markets, so companies, stocks, etc., and also looking at the bond market. And we can start to see that that has started to come down quite a bit over 2025, with that last peak that you can see being from Liberation Day. Now, it's always important to remember with volatility is it's not always a bad thing. It often provides us, again, with investment opportunities where potentially we're getting things on sale. Now, 2025, I know, has been quite an interesting year with lots of ups and downs. But what was interesting for us to look at, if we reflect back over history, is how many all-time highs do you actually typically get, specifically when we're looking at US large cap? And this might be surprising for you, but on average, the number of all-time highs the market reaches in any given year is about 30. And what we've seen from 2025 so far is the number of all-time highs has actually been 36. So although again you might hear in the news that markets are at these all-time highs, and you potentially even hearing talks about bubbles, it is kind of normal what we're experiencing at the moment. So 36 all-time highs in 2025 so far. And if we then have a look at what that actually means from an overall return perspective, what you can see on screen is designed to be a heat map, but actually it's really just a sea of green that we're seeing at the moment. And so what we've got good contributions from your global equity basket, but also some of the more specific regions like Europe and the UK. We've really seen very positive returns come off of the back of that. And again, for me, this points to the importance of diversification within your portfolios, because you will ultimately be exposed to all of these different sub-asset classes at different weightings, and that's all contributing to the overall return that you achieve. Now, if we move over onto the investment opportunities and where we might want to look, you heard me mention AI earlier, and this is looking at a survey done by Goldman Sachs, which surveys institutional investors, over 300 of them, and it asks, what is the most exciting theme that is driving markets? And overwhelmingly, it is AI. What I think is really important with AI as a theme, though, is we've got to look much broader than the implications around technology in particular. And that's something that we're starting to see play out in portfolios, specifically if we look at things like European energy stocks. We can then also start to have a look at what do profit levels look like in different regions. And I've got the US specifically on this slide. Now, you might have heard of the everything else trade, especially with the likes of the Magnificent Seven. So those are your Amazon, Google, Meta. Those are all contributing to a lot of the returns that the US has achieved most recently. But we're starting to see that the growth that we can actually get from a profit perspective is starting to shift to the remaining 493 companies within that S&P 500, which represents the largest 500 companies in the US. And the forward-looking expectations, if we look through into 2026, is that we will still get good profits coming out of those Magnificent Seven, but that we will also start to get strong profits coming from the remaining 493 companies. And a lot of this has to do with some of the backdrop which I've already laid out, which is around interest rates and starting to see those interest rate levels come down, where it then becomes a lot easier for companies, especially that are maybe a bit smaller than those Magnificent Seven, to use debt to continue to grow on their businesses. One of the areas in particular that we're looking at is around small caps. Now, these are your smaller companies which can be represented by the Russell 2000. So that is 2,000 companies in the US, so a much broader set of companies to invest in. And if we look at what the earnings are, so the growth that these smaller companies have actually achieved, you can see that in the red box, 2024 was a really tough year for those types of companies. But 2025 has looked a lot better. And the expectations moving into 2026 look even stronger. And you can see how that then compares to some of the other specific areas of the US market, like the S&P 500, which I've got all the way on the left-hand side. Another area where we see positive investment opportunities is around Japan. And again, this might be something that you've heard of before, but the Japanese market has really entered a very different territory. So while the rest of us have been trying to get inflation down to target levels, Japan have actually operated in a deflationary environment. And this has meant that companies have held a lot of cash on their balance sheets. But now that Japan is actually experiencing inflation, it means that companies can increase the wages of their employees, but it also means they can increase the prices which they charge. And that means that they're in a safer position to start using some of the cash that they've held on balance sheets to actually put that cash to work. And one of the ways that they're doing that is through the concept of share buybacks. Now, share buybacks is essentially when a company buys some of the shares that are currently issued in the market, they buy them back from shareholders. And that is seen as a positive investment from their perspective, and shareholders tend to view that quite positively. So what you can see on this chart is the number of share buybacks and how they've increased. Now, this has been driven by, like I said, the inflationary environment changing, but it's also been driven by some of the structural changes that the Japanese stock market is putting onto companies, where it is saying that you actually need to start putting that cash to work and stop hoarding it on the balance sheet. And you can see the black line showing you what has been that total return of the Japanese stock market since 2015. So looking back over 10 years, we can see that that growth has really been exponential and looking very, very strong for Japan in particular. Now, again, Japan will be a part of your overall portfolio. So it's one of the contributions to return that you might see from your investments. Another area which is also doing share buybacks is around the FTSE, so the top 100 companies listed here in the UK. And what we can see from UK companies, although again, sometimes in the trade press, they might not be perceived as well, but these are companies which are actually providing a lot of return to shareholders. And they do this through dividends. We are one of the strongest dividend payers in the UK. One of the interesting things that I found is the average dividend yield for UK companies is about 4%. If we compare that to the average dividend yield in the US, that's only 1%. So again, it's a slightly different source of return, contributing to the overall diversification of your portfolio. And so what we've seen is the level of dividends that are being paid out by these companies has been at very high levels, but we're also starting to see those share buybacks come through. And one of the reasons why a company might do share buybacks is that's viewed as being able to contribute a higher level of return than potentially reinvesting that money into the business and growing in other areas. So it is seen favorably by the markets. Now, if we move on to Europe, one of the interesting things that we can see here is how well Europe has actually performed over this year. And I'm comparing that to some of the other regions. We only need to look back 12 months ago where US tech was the darling of the investment world and everybody was talking about it. And it has delivered incredibly strong returns this year. But if we compare that to some of the other regions, you can see the likes of European banks, as well as the European defense sector, have also contributed quite significantly. And this chart shows you what has that return been in different currencies. And this is where you can also see what the impact of different currencies are. Sometimes it's in your favor, sometimes it's not. Overall, our view is that over the long term, that the effective currency will actually even out and it won't be as big of a contributor to overall returns. Again, this is one for diversification, just showing that by having your exposure not just to different regions, but also to different sectors can be very beneficial for your portfolio. Moving on then to emerging markets. Now you'll see here, this is the performance just for this year to date. And Korea has actually been, South Korea in particular, has been the top contributor within the emerging market space. I mentioned China a little bit earlier, and we can see that that's also delivered really strong returns. And up until the 12th of November, that had delivered a nearly 29% return within the Chinese stock market as well. And again, this is pointing to the overall exposure that you might have in your portfolio, depending on the different emerging markets that you're exposed to. And they do tend to operate in a slightly different environment. So they have started cutting interest rates a little bit sooner than some of the more developed markets, and that has been supportive for their growth. And in China in particular, it's really been their tech sector which has started to shine in terms of overall returns. Now, something else that might have been in the news, and you would have seen this, is investing in the likes of gold. Now, our view in particular is that we would rather invest in the equity components of a commodity as opposed to holding the physical components of that commodity. And you can see that illustrated really nicely with the two charts I've got on screen here. The first one on the left-hand side is looking at how has the price of oil changed over the last 10 years. And then looking at that relative to a specific stock example, which I'd looked at here, which is around ExxonMobil. And you can see that the return you've got from investing in that company has been better than holding oil in particular. And the same is true for gold. And in fact, it's even more extreme from a gold perspective. Gold has had an incredibly good year. It's been very, very strong. There's been a lot of speculative buying when it comes to gold. But actually, if you had held something like the Van Eck Gold Miners ETF, the return you would have achieved from holding the companies exposed to gold has actually been much better than if you were to hold the physical commodity. And again, it just shows that level of diversification that you can get in portfolios. Now onto my final piece, which is really just looking at spending time in the market. And the journey I'd like to take you on now is just looking at data from history to say, how has this typically looked over time? And the first one we're going to look at is the monthly averages when we are looking at US large companies. And what you can see on screen here is I've got two bars. I've got one bar which shows you what is the average monthly return of these big US companies for each of the months. And this is data which goes all the way back to 1928, so nearly 100 years worth of data. And you can see that the year can be a bumpy ride. We tend to have okay returns in the beginning, maybe a little bit negative in some months. We then have summer, which tends to be very good. We then have a bit of a choppy autumn. And then we have this concept of the Santa rally, where we start to see good, strong returns going through October, November, and then even December tends to have good returns. The lighter green bar that you can see on screen is showing you what does 2025 look like. And again, you can see how that has been a bumpy ride. But ultimately, if you stay invested throughout this process, those returns start to average out, and that's what ultimately contributes to that overall cumulative return that you might see. Now, if we zoom out a little bit and we don't just look at the monthly data and we look at the overall annual data, this is again going back looking at various calendar years of US large cap companies, and it says what has that return actually been for each of the calendar years. Now, all of the gray lines represent all of the historical calendar years, and then I've highlighted a couple which were notable. So the first one is 2022. I'm sure I don't need to remind anyone about how painful that was, even for cautious investors, because we saw both stocks and bonds going down over that year. But then 2024 is another example I'd like to pull out, and we can see that returns were really strong for 2024. 2025 so far has again been that bumpy journey, where in the beginning half of this year it was looking closer to 2024. Then we had those fears of Liberation Day, and we started moving down to the likes of the 2022. But now we've rebounded quite significantly off the back of that, and it is looking like 2025 will finish on a relatively strong note if we compare that to history. Now, what's interesting for me is if you look at all of the grey lines, you can see how wide the level of return can be in any calendar year. And that's why we like to zoom out even further. And so if we then take all of the history at a global level and we say, okay, what does the typical calendar year look like? Looking at data going back all the way to 1987 in this case, because I'm looking at it globally, we can see that overall a calendar year tends to go up on average. And 2025 has shown that as well. You can again see that fall that we had over Liberation Day, but the rebound has been quite significant. And so if you were exposed to fear, or maybe you were a bit concerned about markets, you can see if you were to sell out at that peak fear moment, you actually would have locked in a lot of those losses, and you wouldn't have necessarily experienced the recovery off the back of that. And so the message for us really is to make sure you stay invested, even when it does feel a little bit bumpy, because really over the longer term, you do tend to see that markets continue to move up. And if we zoom out even further and we look at this again from a global perspective, all the way back to the 70s, you can see that this message holds true. And there are those ups and downs that you can experience, but overall that bumpy journey provides us as investment managers an opportunity to buy things on sale. And we think that's a good thing for you to be able to access those types of investments, knowing that not everything is going to go up at the same time. And that means that not everything is going to go down at the same time either. And if we then look specifically at a Tatton portfolio, what I want to highlight here is really the consistency with which we aim to provide performance. And so the green bars, which typically sit above the zero line, that has been the calendar year return for our typical Tatton core balanced portfolio. Now, this might be true for other balanced portfolios that you see in the marketplace, but a balanced portfolio typically has about 60% of the portfolio invested in equities, so stocks, companies, and then at 40% invested in fixed income or bonds. And what we aim to deliver is each calendar year, we aim to deliver consistency when it comes to returns. And so the red lines that you can see is how much did this portfolio actually fall during the course of that year? You can see 2020 as a great example. This portfolio at one point during that year was down 20%, but ultimately the portfolio still ended the year in positive territory with a 5% return. And it's staying invested through each of these ups and downs that actually lead to the overall cumulative return that you can see. If we're looking at it annualized since inception for these portfolios, the average return is 7%. And then if you look at the average drawdown that you might see, or that pullback, how much the market has actually, or the portfolio has actually fallen, it's down 7%. And so it really does pay to ultimately stay invested in these portfolios. Now, if I can just leave you with a couple of key takeaways, what I'd really just like to highlight is that any investment manager that you make use of, whether it be Tatton or anybody else, portfolios really need to be focused on being managed with discipline and foresight. And from our perspective, that is exactly what we're doing. We're monitoring portfolios on a daily basis. Every morning we have a call at 8:40, which looks at what are some of the trends happening in the markets. Are there any opportunities we need to pay attention to? Are there any risks which are present? And how might we try and mitigate against that or take advantage? And that's why for us, really, volatility is something which is completely normal. And we're looking for where is the opportunity of volatility? Where does it give us that opportunity to invest in segments of the market which are going to add value to your portfolio? And it really is about being diversified, holding a range of different asset classes, holding a range of different regions, and then ultimately looking at the overall sectors. So do we want to be exposed to defense? Do we want to be exposed to financial services? Do we want to be exposed to energy? All of that actually contributes to the overall return that is achieved in portfolios. And we are seeing signs of resilience. The market has been quite strong. Despite some of the negative news that you might have seen, markets are still reaching those all-time highs. And that is what we're hopeful will continue through the Sansa rally towards the end of the year. And ultimately for us, it's about being prepared for what's next. Like I said, we are always monitoring your portfolios, making sure that we're taking advantage of the opportunities, and we're not complacent when it comes to running money. Our approach is to be one of stewardship. So we want to be good stewards of your capital, making sure that we can continue to grow that over the long term. I hope this has helped, and thank you so much for watching this. And if there are any questions, feel free to reach out to your financial advisor and we'd be happy to get in touch.